No, Timothy. Hey, Pat, this isn't an investment question, but more of an economic one. When it comes to bond yields, what are the different bond yield durations influence out in the real economy? And then he's got a big essay here from the 1 month all the way up to the 30-year bond.
Okay.
Can you explain?
So yeah, so really what it comes down to is this. Everything is always matched to duration. So when you're talking high yield junk bonds that have an average 3 to 5 year duration, then the credit spread is measured by their comparative rate. And when you're talking about 30-year fixed mortgages, they're being anchored off of the 30-year yield, right? And the spread over that 30-year yield. While if you're looking at money market rates, they're anchored off the 1 month, right? Like everything is relative. And the whole point of when central banks do something like yield curve control, what they're trying to do is target a certain part of the economy that's sensitive to these particular interest rates, change interest rates at that part of the curve while offsetting somewhere else. They're basically trying to say, where are the vulnerabilities and where do we want to slow things down and where do we want to accelerate things up? They choose where they're doing their, let's say, quantitative easing, where are they buying bonds? They can choose all sorts of stuff to manage that. Overall, short-term lending is, and hence why the Fed controls it, is by far the greatest impact. Because the overnight repo markets, and more importantly, the ability for people to stay in cash and be paid for not taking risk is an important variable in the risk equation, right? Why would you take the potential of making 5% in the stock market versus a guaranteed 5% yield? The fact is that you need a risk premium over interest rates on that. And so the more that you raise short-term interest rates, the more you incentivize the hoarding of cash and not liquefying risk assets. It's where the most dramatic impact comes in,